Again, good morning, my Eco 23 15 student. So we are left with two short chapters. One of them is going to be covered today. Hopefully, we may not be able to get through the last chapter, so that's why I'm recording the lecture for the last chapter just in case, which is chapter 15. So that just in case we don't get to it by Thursday tomorrow, you can watch the video and get ready for the exam. So anyway, I'm going to share my screen and I talk about it on the other side. Okay, so in chapter 14 is a chapter on money supply. We talked about how we measure the money supply. We talked about M1, M2. We talked about the money creation process. We talked about the multiplier. And then we also talked about the role of the Federal Reserve. And then we wrap it up by talking about some model, the quantity equation and the Taylor rule. So in this chapter, we are going to start delving deeper into monetary policy. We're going to talk about if the Federal Reserve implements monetary policy, like say increasing or decreasing the money supply, which sometimes lead to an increase or decrease in interest rate. How does that affect economic activity, like real GDP, employment? But the most important thing that we want to start diving in first, we want to start talking about the broader goals of monetary policy. What are the goals that the Federal Reserve, as our central bank here in the United States, want to achieve? Okay, so let's talk about it. So here's going to be some outline. So we'll define monetary policy, what it is, and we're going to talk about the market, the money market, and the Federal Reserve's choice of monetary policy targets. And we'll talk about monetary policy and economic activity, like what I said, if the Fed decreases or increases interest rates, what are the impact on economic activity, like real GDP, price level, movements in the economy, and maybe employment. So we can also talk a little bit about the monetary policy in the dynamic aggregate demand and aggregate supply model. And then we shall do a closer look at the Fed setting of monetary policy targets. How does the Fed target policy? And then the Fed policies during the what? The financial crisis of 2007 to 2009 and during COVID recession of 2020, when we had the pandemic, what did the Fed do? So there's a chair. This guy who's standing here on the far right corner of the screen. That's the current chair of the Federal Reserve. That is Jeremy Powell. Okay. So the chairman of the Federal Reserve is one of the most powerful positions in the country because they're in charge guiding our policy of the Federal Reserve System that has got a tremendous impact on our economy. So the financial crisis of 07, 09, okay, was really deep. Was the first to hit the United States since the bank panics of the early 1930s. So it was so deep that it was comparable to the Great Depression of the 1929, 1930s. The COVID-19 pandemic of 2020-21 was the first disease outbreak to push the U.S. economy into a recession since the Spanish flu, the 1918 Spanish flu influenza pandemic. But many experts believe that the Fed's rapid responses to both events saved the financial system from collapse and limited the severity of the recessions. However, the Federal Reserve actions were not without criticism. Some people think that the Fed maybe might have overstepped. So we'll talk about some of those criticism as well. But the first thing I want to talk about, what is monetary policy? Okay. So in the last chapter, we introduced the monetary policy tools at the Federal Reserve. But just when somebody asked you, what is monetary policy? We've defined this already over and over in this class. But I just want to revisit it again so that we don't get locked up or get like really confused by this. So let me define it, then we can talk a little bit more about it. Okay. So what I'm saying is, when somebody asks you to define, say, what is monetary policy? Monetary policy are going to be defined as these are actions taken by the Federal Reserve, which is our central bank here in the United States, Federal Reserve System, to control the stock of dollars. Stock, you can say stock, or you can say supply of dollars and interest rates in the economy. Interest rate in the economy. So the Fed has got some tremendous control over the interest rate. Okay. So when the Fed changes interest rate policy, those are actions that are taken by the Fed. So we call those monetary policy. So, so having defined it, let's go dive deep into it and start talking a little bit more of how we implement monetary policy. Okay. So in the last chapter, as I said, we introduced the monetary policy tools that the Federal Reserve can use to influence the money supply. And those tools include things like buying and selling of treasury bonds, what we call open market operations. They include things like the discount rate, because the Federal Reserve gives discount loans to banks and charges this interest rate called the discount rate. So if the Fed wants to make it easier for banks to access loans from the Federal Reserve may lower the discount rate. And if banks find it easier to access discount loans from the Fed, that will be easier for the banks to extend such loans to we, the non-bank public and corporations at a lower interest rates. That's how money supply is going to increase in the economy. If the Fed wants to decrease the money supply using its discount lending policy, they're going to jack up the interest rate. The discount rate is going to go up. That they make it less attractive for banks to borrow money from the Fed, because if its interest rate is high, discount rate is high, banks are not going to be able to borrow a lot from the Fed, and therefore that constrains the ability to extend loans to we, the non-bank public. And then we also talk about the reserve requirements. The Federal Reserve, the Fed is a banker's bank, and the Fed regulates all private banks in the United States. So all banks are required, banks that accept deposit and give loans, they are required to keep a minimum share of every customer deposit as required reserves. The Fed might say, for every deposit made in any bank in the United States, 10% must not be loaned out. Okay. So, but the Fed is not going to be following every depositor who's depositing money like in Bank of America. All the Fed needs to do is just wait up to the end of the 2 weeks period and look, because the Bank of America has got an account with the Fed. They're just going to look at Bank of America's balance sheet and look at the total deposit made in the 2 weeks period, and then look at what, as Bank of America kept the 10% minimum reserve requirement. If not, then Bank of America could be subjugated to some kind of penalties by the Fed. Okay, so we're going to address how and why the Fed takes actions that it does. So we'll pay special attention to the unique circumstances surrounding the recessions of 2007, 2009, and the pandemic. Okay, so what's the role of the Federal Reserve? So when the Federal Reserve was created in 1913, it was created through an act of Congress. The Federal Reserve Act of 1913 was passed in Congress to create the Federal Reserve System. So before 1913, we did not have a central bank. So the main responsibility of the Fed was to prevent bank runs. Bank runs, also you can also call it bank panics, is the idea that it's a general idea that when a bank start failing, Americans may decide to start rushing to withdraw all their money from all their banks, from all the banks, and that's going to trigger, even multiple banks failing. So when we have a run on the bank, is the idea that we all trying to go to the banks to withdraw our money because we are worried that the bank was going to fail. And if we do that, banks are going to fail anyway. Okay. So to prevent that from happening, that's why Congress say, okay, we need an institution of government that kind of provides some kind of assurances, because the Federal Reserve lends money to banks during crisis time when banks don't have enough liquidity. The Fed gives discount loans to banks to stabilize the financial market and the financial institutions. So that brings some kind of assurance to Americans that the banks are not going to fail, right? So after the Great Depression of 1930s, Congress gave the Federal Reserve this broader responsibility to act so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Those are the goals of the Federal Reserve. But there are other goals too, like stabilizing the value of the dollar, promoting broad economic growth. Okay, so since World War II, the Fed has carried out an active monetary policy. Monetary policy, as I said, is the actions the Federal Reserve takes to manage or control money supply and interest rates to pursue macroeconomic policy objectives. That's what I defined earlier. Okay, so so here are some of the broader goals of a central bank like the Federal Reserve. Okay, um, the Federal Reserve pursues four main monetary policy goals. The first one is price stability. Price stability is the idea that we want price in the economy not to be so volatile, to be stable. The goal here is to control what? Have a control over inflation. Control inflation. We want to make sure that inflation doesn't get out of hand. And also deflation. Deflation is the opposite of inflation. Deflation sometimes can also be very devastating, when price again drops so much, it's bad for the economy too. So we want prices to rise, but at a modest, moderate level that does not, turn into a rout. And then the Fed also promotes high employment. If there's high unemployment in the economy where Americans don't have jobs, the goal of the Fed is to make sure that they put in tools that ensure that the economy is growing to create more jobs more jobs for Americans. So they promote high employment. That's one of the main goals. So when the Federal Reserve Act was written in 1913, Congress, these first two goals of monetary policy is what Congress called the dual mandate of the Fed. So that means Congress cares a lot about the first two goals of monetary policy than they do on the other. That doesn't mean they don't care about the other two, but they always make sure that the Federal Reserve is controlling these two things appropriately. Because if the economy, so we are controlling prices and inflation is not getting out of whack, we have high employment in the economy. Those are the things that matter. And then, of course, the other goals are going to be stability of financial markets and institutions, because the Fed regulates institutions like banks. The idea is that we don't want banks to be making bad decisions that could lead to maybe instability in the financial when banks start failing. So the Fed regulates banks to make sure that banks, there are some guardrails that banks should abide by, so that they're not making bad decisions that can lead to their collapse. And then, of course, economic growth. The Fed is going to promote the goal of increasing output, GDP every period through its policy. So we're going to consider each goal in turn. So goal number one, which is price stability. So rising prices, as we said, reduce the purchasing power of our money, of our dollars. During the 1970s, especially the late 70s, when Jimmy Carter was president, inflation got out of hand. It became problematic in the United States. Inflation was so high, it peaked almost about 16%. That's how bad one of the highest inflationary episode in U.S. history. So in 1979, when inflation was getting out of control, Paul Volcker was appointed the chair of the Federal Reserve. And he aggressively came and put a hammer on inflation to control. He used monetary policy to get inflation under control. So when we went in the middle when Ronald Reagan was president in the middle of the 1980s, inflation was brought from like 16% down to like 3.7%. So since that time, the Fed does monitor inflation, but recent policy changes discussed later caused the Fed to place less emphasis on inflation. Some critics fear that early in 2021, policies may allow inflation to accelerate, because what happened in 2020 and 2021, we had COVID, the pandemic, and then the vaccines came in, the rollout of the vaccine in early 2021. The government spent a lot of money for vaccine distribution, for bailing out the economy. So they pump a lot of money in the economy, and the result was inflation. So we'll talk a little bit about that. So you can see for yourself, inflation in the United States, percentage increase in price. As I told you, inflation was the highest in the 1970s till the early 80s. See, it almost peaked at 15%, around 15, 16%. But since then, when Paul Volcker became the chair of the Fed, and somewhere around 1979, when the inflation was almost at its peak, he aggressively used monetary policy to bring down prices. You see, so inflation has been very stable since the mid 1980s, and it has remained low. until recently. Again, if you extend this data point to 2021, 2022, you're gonna see 2023 for this thing shot up again, but it didn't shoot up like a 1970s. The inflation went up. That's why things are so expensive when these days when you go to HEB or whatever, for the last 3 years because of rising prices. But the inflation that we are experiencing now or in recent times, uh, cannot only be attributed to the Fed increasing the money supply or government pumping money in the economy. It can also be attributed to supply chain issues. Because remember when COVID hit, China shut down the economy. So most US companies get their raw material goods for production from China. So since they shut down the economy, that brought a lot of supply chain issues, and that we were not producing enough output due to supply chain problems. So that also contributed to the rising prices that we see today. Okay. So the second goal of monetary policy is high employment. So the main goal is high, price stability. But the second most important goal is high employment. So at the end of World War II, Congress passed what we call the Employment Act. See that the Employment Act of 1946, which stated that it was the responsibility of the federal government to foster and promote conditions under which there will be afforded useful employment for those able, willing, and seeking to work, and to promote maximum employment, production, and purchasing power. So price stability and high employment are often referred to as the Dole mandate. I talk about that, the Dole mandate of the Fed. The Fed is going to mandate or require that the Federal Reserve, they're promoting the broader goal of price stability and high employment. And then goal number 3 is stability of financial markets. So stable and efficient financial markets are essential to the growing economy. If you don't have a well-functional financial system, then the economy doesn't function very well. What do I mean by financial markets? I'm talking about the stock market, the bond market, the currency market. And now we have cryptocurrency market, which is still unregulated for the most part. And then, of course, financial institutions like banks need to be, we need to regulate banks, make sure that banks have the stability in the financial institutions as well. So the Fed makes funds available to banks in crisis times. Okay, when times when our banks are maybe they have liquidity problems, the Fed is going to make sure that there are funds available, standing ready to lend to those banks that might be in liquidity problems. In 2008, the Fed temporarily made these discount loans available to investment banks as well, because the crisis deepened, because the Fed traditionally only loaned money to what? Commercial banks that accept deposits and give out loans. Investment banks do not accept deposit. These are like hedge funds, like mutual funds, pension funds. So those non-bank financial institutions, which we normally call them investment banks, were also in serious liquidity problem during the financial crisis of 2007, 2008, 2009. So the Federal Reserve also jumped in. Not only did they lend money to traditional commercial banks, but also the non-bank financial institutions like, pension funds, insurance companies, and others. So in 2020, the Federal Reserve adopted similar policies during the COVID pandemic because we shut down the economy and banks were in a serious trouble. The Federal Reserve also made sure that the banks had access to discount loans. Then the last goal of monetary policy is promoting economic growth, particularly stable economic growth. And so the idea here is that, the United States economy is one of the most stable economies in the world, if not the most stable economy. Actually, I would say it's the most stable economies in the economy in the world. Why? America has exhibited like sustained economic growth since after World War II. Okay. So when I say sustained and stable long-run economic growth, is the idea that the economy does not grow like 10, 20%. Okay, we have to be stable. We grow at about 2-3% on average, but we sustain that for most of the periods. If you go to some other countries, a country can grow by 20% this year, then next year they grow by negative 20% or negative 15%. Then again, they grow by 3%. So they're so volatile, it's very unstable. For the US, growth might be relatively low, but stable. We maintain that stable, long-run economic growth, okay? So it's not clear to what extent the Fed can really encourage long-run investment beyond meeting the previous three goals. Congress and the president may be in a better position to address this goal. So Congress and the president or the executive branch can use fiscal policy, because that's what Congress controls for the most part. They can use tax policy and government spending policy to address some of the issues on economic growth. So let's talk about the tools of monetary policy, okay? So the monetary market and the Federal's choice of monetary targets. So we're going to describe the Federal Reserve's monetary policy targets and explain how expansionary and contractionary monetary policy affect the interest rate. So the Fed has got three main monetary policy tools at its disposal. The Federal Reserve has got what they call the open market operations, which is buying. We saw that in the previous chapter too, buying and selling of securities, mostly treasury securities, treasury bonds. And then the discount policy, this is a Fed's lending one. Fed lending to banks, charging a discount rate. So the discount rate is the interest rate that the Federal Reserve will charge banks when banks borrow money from the Fed. And then, of course, this one is what we call the reserve requirement. The Fed sets a minimum reserve requirement on bank deposits. So minimum reserves are basically the amount is part of the customer's deposit that banks must not loan out or invest in securities. So the Fed is going to use those tools to try to keep both unemployment and inflation rates low. It does this at least in normal times by directly influencing the monetary policy targets. So let's talk about the monetary policy targets. One is the money supply. The Fed is going to set somewhat of how much money we need in the economy, how much the rate at which they print money. So they could say we're going to let the money supply grow at 3% every year, but it could be consistent with the rate at which the economy is growing. But the primary monetary policy target of the Fed since 1993, okay, the Fed used to target the money supply, but since 1993, the Fed has set a target on interest rate, and the interest rate that the Federal Reserve targets is what we call the federal funds rate. I'm going to talk about it shortly. Okay. So, but before I talk about it, let's talk about the broader money market. Okay. So the money market, when I say money market, that's a market where we determine market interest rate. So the Fed's two monetary policy targets are related in an important way. So high interest rates result in lower quantity of money demanded in the economy. You know that if interest rates are very high, Americans are not, okay, I want to make this very clear because sometimes it gets confusing, especially when you're taking this for the first time. So in economics or in monetary economics, when we say money demand is the same thing as the amount of money that individuals, when I say individuals here, you could just say Americans, want to hold. Okay? So money demand is enough. So anytime I say money demand in this class, it is synonymous to money holding. The amount of money that you are holding in your purse, your wallet, at home. I don't know how you keep your money. You either store it. And money which is outside of the banking system is your money demand. Okay? So now the question is, remember the money that is outside of the banking system that you have in your wallet, you have under your pillow at home or wherever you keep your money. That money does not earn you any interest rate. If I kept $10,000 under my pillow put it there on January 1, 2025. Trust me. I'll wake up on December 31, 2025. It's still $10,000. The money which is outside of the banking system does not earn you any return. So what do you mean? So now what does that mean? So that means if interest rates, because Americans are smart, we know everybody's smart. Everybody wants to make money. So the idea here is that if interest rates, that banks interest rate, that banks pay on bank deposits, like savings account, mutual funds, certificate of deposit are high, Americans would lose more money, in foregone interest if they kept the money at home. If they kept the money at home, instead at home, I mean money in your wallet, in your purse, under the pillow, wherever you keep it, or in your piggy bank, instead of depositing it in a bank. That's right. So because Americans are wise, they know that they're losing money. If just think about it. So if interest rate, let's say interest rate that banks are paying was, suppose interest rate is 20%. That means you would lose $200 for every $1,000 that you keep at home. For every $1,000 that you keep at home. Okay, so now given that background, so it seems now obvious that because Americans will lose a lot of money if interest rates are high, if you keep the money at home, because you're not earning interest rate if you keep the money at home. It has to be in the bank, or maybe you invest it in bonds. Bonds earn you interest rate as well. So that means when interest rates are high, Americans know that they're losing a lot of money. That's not a smart choice to keep money at home. So Americans are going to hold less money. Okay. So the idea here is that when interest rates are high, we are going to hold less money. So high interest rate leads to low money demand. And I remember money demand is the same thing as money holding. Okay. And vice versa. So interest rate is like the price of money, the price you must pay, okay, or the opportunity cost of holding money. So now, having said that, so interest rate is a price of money, the price that we must pay if we choose to hold money instead of what? Leaving money in some interest-bearing account with the bank. Okay, so we're gonna say the word interest rate is the price of money, the price of holding money. Or sometimes you can define it as, or can also be defined as the opportunity cost of money holding. Opportunity cost. You guys learned from year 2314. Opportunity cost is what you must give up if you make a choice to do something. So you're going to give up the interest rate that you should have earned if you choose to hold money. So that's why the interest rate can be defined as the opportunity cost of holding money. Okay. So that means now there's a negative relationship if I put on here quantity of money demanded or money people that are holding, because money demand is the same thing as, and then on this axis, I'm going to put interest rate, which is, the price goes on a vertical axis. So we're saying the interest rate is the price of holding money. And we're saying that there's an inverse relationship between holding money and interest rate. So your money demand function slopes downwards. MD stands for money demand. Money demand curve. So if the interest rate is high, let's say this is I1, I stands for interest rate, nominal interest rate. Americans are going to hold less money, see? Because you lose more money when banks are paying high interest rate on savings account, or bonds are handing high interest rate and you're holding a lot. Americans are going to hold less money. But if interest rate is very low, let's say it falls to I2, then people are going to have an incentive to hold more money, because they're saying it doesn't pay anything anyway if you put in a bank, because interest rates are very low. So you're going to move from point A on the money demand curve to point B if interest rate falls. You move along the same money demand curve. Okay? So that is a relationship I'm having here. If I have interest rate on this axis as a price of money, this is a quantity of money in trillions of dollars that is demanded by all Americans. So the money demand curve is sloped downwards. So when interest rate is 4%, Americans are going to hold less money. They only hold $3.5 trillion in total. This for all Americans combined. And when interest rate falls to 3%, because there's an inverse relationship between interest rate and the amount of money people want to demand or hold, then the quantity of money demanded is going to fall. See? So the opportunity cost of holding money is higher when the interest rate is high. Opportunity cost of money holding is the interest rate. Okay, so now let's talk about factors that can shift the what? The money demand curve. If interest rates change, you can see that you don't shift the money demand curve. You move along the money demand curve. You see that? If interest rates fall or rise, you move along. But there could be other factors that might shift that money demand curve, even though interest rate might not have changed. Okay, so let's discuss a few of those. So now you understand the movement along the money demand curve. But let's talk about factors which shift the money demand curve. Okay, money demand curve, left or right. Remember, when you talk about demand and supply, when you talk about the price changes, you move along the demand curve. But there are other factors that could shift the entire demand curve. So the first one is going to be increase in GDP, increase in real GDP. Remember, GDP is a measure of what? Of income. So if the economy is doing well, if the economy is doing well, okay, it implies that it means many Americans have jobs, have employment, and income is rising. When the economy is doing well, it means GDP is growing, the economy is growing. So when income is rising, so this leads to an increase in money demand. This leads to an increase in money demand, and vice versa. In other words, when the economy is doing well, where the economy is growing, real GDP is high, income is rising, Americans will demand more money to go shopping because they have income in the first place. But if the economy sucks, that's what I'm putting vice versa here. You will wake up tomorrow and there's the economy enters a serious recession where there's high unemployment. That means real income or American income of Americans are falling in recession because there's high unemployment. People are out of jobs. Then the demand for money is going to shift to the left. So the demand for money, you put interest rate here, and I put my quantity of money demanded on this here. So if this is your money demand curve one, let's say this was interest rate I1. What I'm saying is that, okay, at this interest rate, let's say this was money demand one. Okay, the money demand curve is going to shift to the right like that when interest, at constant interest rate, when there's an increase in income, when the economy is growing. And it shifts to the left like this when Americans don't have jobs. So that's what we're drawing here. So income or higher real GDP means economy is growing. Money demand curve shifts to the right. And then the second factor which shift the money demand curve, we discussed that already. Let's talk about the second factor. Need a new slide here. Why do people demand more dollars even though interest rate might not have changed? The second factor is going to be two, change in the price level, changes in the price, in the general price level. Okay, this is no brainer. If prices of goods are rising, if prices rise, you need more dollars. You need more dollars to buy goods and services. So the money demand is going to shift to the right. Money demand will increase and shift to the right. And vice versa. Just think about 3-4 years ago when groceries were still cheap at HEB, Walmart, and other places where you guys do your groceries. If your family went with $200, like 4 years ago, they would come back with some groceries. You go with $200 today, you may not get groceries. So what does that mean? So if prices of goods are rising in the economy, and we want to buy the same amounts or similar amount of goods that we were buying when things were cheap, then you need more dollars to go and get the same amount of goods because they've become more expensive. This is a no-brainer. Everybody knows this. Okay. So, for example, let's just pick one good. Let's say gasoline was $2, okay, in 2019, before COVID. So that means, let's say if you need 50 gallons of gasoline per month to drive back and forth to work, that means you need $100. You needed $100 in 2019, $2 per gallon times 50 gallons, that's $100. To fill up your gas tank that will get you to work and, to 5-day work week, or you go to work 3 days a week, whatever. But what I'm saying, what about if gasoline increases to $4 a gallon let's say in 2024? That means you need twice as many dollars that you were for filling your tank. You now need $200 because 4 times 50 gallons is $200. So the demand for money is going to shift to the right when prices are rising in the economy because people will demand more money. So put interest rate here, put quantity. So if this is my initial money demand function and this was my interest rate, money demand 1, then this is I1. At this point, the money demand curve is going to shift to the right, MD2, when there's an increase in what? In the price level. But when prices fall, that's why I'm saying, and vice versa, then the money demand curve is going to shift to the left. When prices are falling, that means things are cheaper. You don't need a lot of dollars because they're cheap anyway. You're going to hold less dollars. Because one of the reasons why you're holding money is you're most likely going to use it to spend on goods and services. So your money demand is mostly for transaction purpose. Okay, that's why I was saying that. So we connect it to the general price level. If the money that you normally hold in your wallet or in your purse is most likely going to be spent, then that spending is going to depend on the price level. So the amount of money that you need, you want to hold or you want to demand is going to be contingent on how what the cost of goods are. Okay. Okay, so third factor that will shift the money demand curve, you can talk about expected inflation. So if Americans, when I say expected inflation, I mean the word expected is like some kind of future. It has not happened yet. Something we are just expecting something bad coming. So if Americans expect prices to be rising in the near future, prices to be rising in the near future, what does your family do? What's a smart choice for your family? Let's say your family was planning to buy electronics, furniture for your home. And somebody tells you that, oh, in 6 months or in a year, the furniture price are going to go up 30%. Maybe tariffs are, because we're imposing tariffs on foreign goods, maybe lumber coming from Canada. We use lumber to make furniture. So if tariffs are imposed on the Canadian lumber, that is coming to the US, that's going to increase the price of lumber, and that's going to make the cost of producing furniture high. So if Americans are predicting because of tariffs, their furniture is going to increase in 6 or 1 year. They want to buy today. So if Americans expect price to be rising in the near future, they will increase their demand for money today to buy goods, when they are still cheap. So the money demand curve will shift to the right. There's an increase in money demand in this case. Shifts. Remember, when the money demand curve shifts to the right, that means an increase in money demand. Shifts right. And vice versa. Vice versa means that if Americans are anticipating that in the near future, prices are going to be falling instead of increasing, that means they're going to be cheaper in the near future. Then they're going to stop buying today. They're going to maybe wait a little bit. When prices fall, then your family is going to want to buy when it's cheap. So when they're waiting, that means the demand for money today is going to fall. Okay, so that's how you connect those dots. Okay. So now we want to talk about the supply of dollars in the economy. Okay, we talked about the demand side because a market has got a supply side and a demand side. What about the supply of dollars? So we talk about the money demand side, the demand side of the money market. Now let's discuss the what? The supply for money. Open more slides here. Okay, and we're going to talk about how the Federal Reserve. Okay, so let's talk about it. Okay. So what about the supply of dollars in the economy? Supply of money. You can just say, for our case, the supply of dollars here in the United States. So we know, we saw in the previous chapter that the Fed, the Federal Reserve, controls the amount of money in the economy, or the amount, or you can call it stock of money, or the supply of money, mean the same thing. Supply of dollars in the economy. But the supply of dollars is fixed at every point, at every time, at every point in time. Because the Fed is the one that fixes one. If the Fed wants $10 billion, $10 trillion, they make sure it's $10 trillion. If they want $11 trillion, then they're going to print more money, okay? So but every point, the supply of the dollars is fixed. Okay? So that means the money supply curve, since it's controlled by the Federal Reserve, is independent of interest rate. So if this is your interest rate on this axis, and this is your quantity of money, now we're talking about supply side, quantity of money supplied, the money supply curve is going to be fixed. It's this vertical line. So you can level this money supply. Meaning that if interest rates are low, money supply is going to be the same. If interest rates rises, it's the same. But the question is, how does the Fed change the stock? Because they're saying the supply of dollars is fixed at every point in time. Is that vertical line? Then how does the Fed increases or decreases the supply of dollars? How does the Fed increase or decrease the supply of dollars? So we talked about this in the previous chapter. So tools of monetary policy. So tools of monetary policy, these are the things that the Federal Reserve will use to change the supply of dollars in the economy. And what we discussed in the previous chapter, chapter 14, the most important tool of monetary policy is the open market operations. So open market operation is buying and sometimes selling of treasury securities or securities to either banks or to the non-bank public. Okay, a bond is a piece of paper, it's an OU document, which guarantees that the holder must be paid a certain amount of income plus interest. Okay, if you go and buy a US Treasury bond and you're holding, let's say you gave the US government $10,000, the government is going to issue you a certificate. It's just a piece of paper showing the terms of the contract that you have lent money to the US government by buying the US Treasury bond. And the government is going to pay you back, say, in 5 years with interest. That's what a bond is. So when the Federal Reserve goes, when the Fed goes and buys these pieces of paper from the market or from banks, the Fed is taking away these agreements from the public or from banks, but leaving the banks or the public with money. That's how money supply goes up, okay? So to increase the money supply, the Fed, which is an acronym for Federal Reserve, conducts an open market purchase, an open market bond purchase from either banks or the public, the non-bank public. Okay? And vice versa. Vice versa means if the Federal Reserve were to want to decrease the money supply in the economy, they're going to sell treasury securities instead. Okay? They're going to sell these pieces of paper called bond, these agreements. When you sell the Fed, so that means the Fed is selling it, dumping this whatever in the market, and taking money from it because people have to pay for it using money. That the Fed is withdrawing money from the economy. So money supply in circulation is going to fall because the Fed is leaving the public and banks with this agreement called bonds, but taking away the money because they're using the money to buy those bonds from the Fed. Okay, so there are two. So now, the first one, the two types of, as I explained there, two types of open market operation, which we also talked a little bit about in the previous chapter. Okay, so first one is what we're calling expansionary monetary policy. So if the Fed is expanding monetary policy, that basically means the Fed buys securities or bonds. The Fed is going to conduct an open market purchase of bonds or securities, okay? And this will lead to an increase in money supply. My notation for money supply is MS, and a decrease in interest rate. And then B as what we call contractionary monetary policy. To contract to make it smaller. So here, the Fed will sell securities or bonds, okay? And this will lead to a decrease in money supply, but an increase in interest rates. That's right. So that's a difference between contraction. So that means, so now let's talk about it a little bit. Okay, so now we're gonna, to see how interest rate is gonna change, we need to put things, now I'm gonna use a graph, put things in equilibrium context, because we talked about the money demand. The money demand slopes downwards, but the money supply is vertical because it's fixed. Money supply is fixed by the Fed. Okay, so let's put things in equilibrium to see how these contractionary and expansionary monetary policies work. You're gonna have something like this. Equilibrium in the money market. So we're going to put interest rate on this axis, and then we'll read the quantity on this axis, quantity of money, supplied or demanded. We have seen that the money supply curve is this vertical line. So if I call this MS1, okay, it's going to be the quantity of money here. And then we embed the money demand curve, which we say is downward sloping. We call this MD. So the point of intersection between the demand for money and supply for money will determine equilibrium interest rate, an equilibrium stock of dollars, M1. So what I'm saying here is that if the Fed pursues an expansionary monetary policy by buying bonds, that leads to an increase in the money supply, meaning that the money supply curve is going to shift to the right when the Fed buys bonds. So this is going to be your new money supply. You can call it MS2, okay? This is going to lead to a higher money supply. Equilibrium is going to go up this way. So the new equilibrium is where the black line, the new money supply curve, intersect the money demand curve. So that is going to lead to a decrease in interest rate. So this is what we're calling what? Expansionary monetary policy. When the Fed is increasing money supply, that is going to lead to lower interest rate. Okay. And then later, I'm going to connect now when interest rates in the economy are falling, that is going to be good for the what? That's how the Fed is going to influence real economic activity. When the Fed buys bonds, that leads to an increase in money supply, and interest rates fall. What do you think is going to happen to business investments? When interest rates are falling, businesses find that attractive to invest money because the cost of capital has gone down. So they're going to invest more. Consumers will borrow more money because interest rates are falling. So but GDP comprises of consumer spending, business spending, government spending, and net exports. So if interest rates fall and that trigger higher investments, higher consumer spending, that's going to increase GDP. So eventually we're going to connect that to what? To real economic activity. Okay. So what about contractionary? So with contractionary monetary policy, the Fed does the opposite. Now, as I explained, the Fed is going to sell treasury bonds or treasury securities. Okay. And then that's going to lead to a decrease in money supply. So let's say, hang on this. So this is a quantity of money, this axis. Then we put always interest rate on this axis. So you must start with a point. This is your initial, this was your money demand function. Then this was our initial money supply function. This is your M1. So this was your initial interest rate before the Fed changed anything. And then the Fed decides to pursue contractionary monetary policy, which in by what? By selling securities. When we say the Fed sells securities, money supply is going to fall. It leads to a shift of the money supply curve to the left, like this. So this is your new money supply, MS2. So this is going to lead to higher interest rate because equilibrium is where the black line intersects the what? The red line. So interest rate is going to rise. That's exactly what we say. Contractionary monetary policy often leads to what? An increase in money supply and a decrease in what? Sorry, that is expansionary. Contractionary is going to lead to a decrease in money supply and an increase in interest rate. That's exactly what you're saying here. Okay. Okay. So that's open market operations. So this contraction, when the Fed decreases, I'll talk about that. But there's a tale of two interest rates here. Because in chapter 10, we talked about the loanable funds market model, which was concerned with long-run real interest rate. Okay. Here we're talking about short-term nominal interest rate in this chapter. Because in chapter 8, so chapter 10, when we talked about the relationship between investment and saving, national savings, we say that what? Real interest rate, which is a inflation-adjusted interest rate, is obtained at the intersection between the demand for investment and national savings. Remember? That would determine what? Real interest rate. But this was real interest rate, not nominal interest rate. In this chapter, though, we're talking about the intersection between money supply and money demand. So the interest rate that is determined here is nominal interest rate, not real interest rate. So now let's talk about the choice of the Federal Reserve's monetary policy target for a second. So the Fed can choose to target a particular level of money supply or a particular short-term interest rate. It concentrates on the interest rate in part because the relationship between money supply, M1 on M2, and real GDP growth broke down in the early 1980s. Economists started not to see a clear-cut relationship between money supply and GDP. That's why in 1993, as I told you, the Federal Reserve started to target what we call the federal funds rate. Okay? So there are many different interest rates in the economy. The Fed targets the federal funds rate. So the interest rate that the Federal Reserve targets is not this interest rate that we're talking about here. But we know that that interest rate that the Fed targets, when it changes or it decreases, then all other market interest rate that we're talking about there is going to go in the same direction. First of all, now, what is the federal funds rate? We talked about this earlier on. The federal funds rate is the interest rate that banks, private banks, charge each other when they loan each other money. So the Fed, the Federal Reserve, targets the federal funds rate. Okay? But the federal funds rate is not the federal funds rate is the interest rate which banks charge each other I say private banks, when they lend each other reserves, which is we can call loans. So if Bank of America borrows money from another private bank like Citibank, Citibank is going to charge Bank of America like a 5% interest rate on that borrowing. Typically, it's overnight lending, like 2 weeks, sometimes 1 month, 6 months. Okay. So here's the federal funds rate over time from 1950s to more recent time. It has fluctuated. In the 1980s, it went up because inflation was going up, so we had to raise interest rate to control inflation. There's a new policy tools that the Federal Reserve started doing. Let me see if I can explain this. Okay. So one of the new policy tools that the Fed has started to implement is paying interest rate on bank reserves. They started that in 2008, the fall of 2008. What do you mean by paying interest rate on reserves? Remember, reserves are bank deposit. We saw that already from chapter 14. Reserves are bank deposit with the Fed. So all banks in America have their account with the Federal Reserve. Just like me and you, we have our account with our bank. You deposit your money in a checking account or your savings account. Bank of America, the Federal Reserve is a banker's bank. That's what we saw in chapter 14. All banks deposit their money with the Federal Reserve. So ideally, traditionally, when you deposit money with your bank, like savings account, even checking accounts earn interest. The reason why you guys don't see interest rate accumulating on your checking account, because you might put money in your checking account today, and then you turn around and withdraw and use it in 2 weeks. But if you put $1,000 in your checking account from January 1 and you leave that money until December 31, it's gonna be more than $1,000. It earns some interest, some little interest. Checking accounts earn interest. So traditionally, what I'm saying is that if we deposit money into our banks, we expect the banks to pay us interest rate on our deposits. But the Federal Reserve, ever since the Fed was created in 1913, the Federal Reserve never paid interest rate on excess reserves on bank reserves with the Fed. But that policy changed in 2008. So in the fall of 2008, the Fed, up to today, the Fed started paying interest rate on reserves, something that they never did before. So we call those interest rate on excess reserves. It's a new tool of monetary policy. Okay. And then there's also what we call, the Fed also started what we call repurchase agreements and reverse repurchase agreements. Repurchase agreements, the Federal Reserve sometimes engages in temporary transaction called repurchase agreement. The Fed can enter an agreement with a bank, with a financial institution like Bank of America. So the Fed is gonna buy a security from a financial firm like Bank of America and promises to buy it back to on the next day. Okay. So the Fed buys in other words, the Fed is going to buy financial security from Bank of America, and Bank of America promises to buy back that security from the Fed. Reverse the transaction. That's why we call it a repurchase agreement. A reverse repurchase agreement is the opposite of a repurchase agreement, a repo. It's effectively borrowing money from the firm overnight. So by raising the interest rate the Fed pays on these loans, it reduces the willingness of the firms to lend at a lower rate, so they can have influence on the lending interest rate in the economy. So using these new policies, the Fed keeps the federal funds rate in its target range. Okay. I know that that section that I kind of discussed is a little bit technical, but know that the Federal Reserve targets the federal funds rate. The federal funds rate is a rate at which banks borrow money among each other, the interest rate they borrow money each other. And some of you might wonder, why would the Fed target the federal funds rate, control the federal funds rate, if it's an arrangement between private banks? Remember, the Federal Reserve can alter the supply of reserves available in the banking system. We talked about that in the previous chapter. The Fed can buy bonds. When the Fed buys bonds from banks, bank reserves go up, meaning that banks have enough funds that they can use to lend to other banks. You understand that? So if the Fed can influence the supply of reserves in the banking system, that means that is going to have some impact on what? On the federal funds rate. Because it's all about supply and demand. All right, so we'll talk a little bit. Okay, so now the other most important thing that we want to talk about, let's talk about how interest rates, which if the Fed can influence interest rate, let's look at how interest rate affect aggregate economic activity, like aggregate demand. Because we say that aggregate demand from your aggregate demand aggregate supply model is a sum of consumer spending, business investment spending, government spending, and net exports. Okay, and then your aggregate supply is the same thing as a real GDP. You know that. So in equilibrium, if aggregate supply equals aggregate demand, then Y equals going to be that. That's the equation for GDP. But the right-hand side of the equation for GDP is aggregate demand, which consists of consumers' consumption, consumer spending, business investment spending, net exports, and government spending. But government spending is exogenous. It's not going to depend on what on this interest rate. We're going to say that that's Congress determines how much they want to spend. So that means interest rates are going to affect only three components of aggregate demand, primarily consumer spending, business investment spending, and net exports. So when interest rates are low, consumers can borrow more on consumer loan like credit cards. That can boost consumption spending. When interest rates are very high, let's say interest rates on credit cards are averaging 25%, then Americans are going to find it expensive to borrow money for consumption purposes. So consumption is going to fall. That's straightforward. We borrow more when interest rates are low. We borrow less when interest rates are high for consumption. Same for businesses. Businesses are going to borrow more when interest rates are low because it's cheaper to borrow that way. But when interest rates are high, businesses are going to borrow less funds for investment. Okay. And then net export. So when the US interest rates are high, it attracts foreign funds into the United States. So let's say interest rates in America rises above interest rates in other countries. And then foreigners are going to find US assets like US Treasury bonds more attractive. So they're going to invest in US assets like Treasury bonds. So the United States is going to attract more dollars from foreign countries. And once you attract more dollars, meaning that for people to invest in the US assets, they need US dollars. If somebody from Mexico wants to buy American US Treasury bonds, we don't price our US Treasury bond in Mexican peso. It has to be in US dollars. So they need to convert the peso into US dollars before they can buy US assets like Treasury bonds. So the demand for dollars are going to go up because foreigners want the US dollars to invest in the US economy. When exchange rates go up, that means the US dollar is going to gain value, appreciate against foreign currency. And that is going to impact our exports to the rest of the world and imports. So net export is going to fall in that case. So higher interest rates is connected to net exports because remember, net exports is exports minus imports. So what I'm saying is that when interest rates are high, increases in America, foreigners want to buy US assets like US Treasury bonds. They want to invest in the bond market here because they earn a higher interest rate than they would otherwise earn elsewhere. Because now foreigners have an appetite to buying US assets, the demand for US dollars is going to increase. When the dollar increases, that means the value of the dollar is going to appreciate, gain is what? Foreign currency. But when the dollar gains too much value, that's not good for US exports. So exports are going to fall and imports are going to rise. So net export is going to fall. So anytime interest rates in America are rising relative to foreign countries, know that the dollar is going to appreciate. And after the dollar appreciates, that's going to lead to a lower net exports. So we send it. But remember, net export is part of aggregate demand. So aggregate demand gap is going to fall. Okay. Now, we can use, and we did this also in chapter 13, chapter on aggregate demand, aggregate supply gap. Suppose the economy is in a recession. We know that the Federal Reserve can act to prevent the recession from becoming severe. Okay. So let's discuss this a little bit here. Talk about how the Federal Reserve, how can the, okay. Can say, how can, now we know that since monetary policy of the Fed, when the Fed lowers interest rate, it affects aggregate demand. Okay. When the Fed raises interest rate, that means aggregate demand curve is going to fall. It's the opposite. So how can we use monetary policy by the Fed to close a recessionary gap? So how do we illustrate a recessionary gap again? Let's draw it here. We did this in chapter 13. So you have the price level here. You have the level of real GDP on this axis. Okay, we know that a recessionary gap is when remember, this is your long run aggregate supply curve that determines potential output. A recessionary gap is when the intersection between the short run aggregate supply curve and the aggregate demand is happening at a point which is not on the long run. See this intersection between aggregate supply, short run aggregate supply curve and aggregate demand is happening here. That means the economy is going to produce this, the actual output is less than what? Full employment. We want the economy, so the economy is right now at point A. There's a recessionary gap because actual output falls below full employment or full potential output. So the Fed is going to close this recessionary gap by lowering interest rate so that the aggregate demand curve is going to shift to the right. When the aggregate demand curve shifts to the right, we close the economy is back at full employment where all the three curves intersect. But that's going to cost you money. Price is going to rise. Okay? So you already know that. So when the economy falls in a recession at point A, the Fed is going to what? The Fed is going to Fed buys bonds or securities. That's what we call it. They're going to pursue an expansionary monetary policy by buying securities. When the Fed buys bonds, we know that leads to what? That leads to increase in what? In money supply. We already did this. And lower interest rate. So but we just discussed, we're saying that aggregate demand is a sum of consumer spending, investment spending, government spending, and net exports. So we know that when the Fed lowers interest rate by buying bonds, because that's what the Fed is going to do because they need to close the recessionary gap. That is going to lead to higher consumer spending when interest rates fall, higher business spending, and higher net exports. But all those are components of aggregate demand. So aggregate demand curve is going to go up. That's the reason why it shifts to the right. That's how the Fed is going to close the what? The recessionary gap. And then on the other hand, the Fed can also close the what? Inflationary gap. Because there are two types of gaps that we learn in what? So we can say, how can the Fed close an inflationary gap using what? Monetary policy. So again, inflationary gap, remember, means what? It means, inflationary gap means your actual output, Y without anything, is greater than your full potential output, YP. We saw this in chapter 13. So in this case, the Fed must sell securities or bonds to banks and to the non-bank public. When the Fed sells securities, we know this is going to lead to what? Leads to lower level of money supply. Money supply is going to fall. And interest rates will rise. Interest rates will rise, leading to a decrease. Aggregate demand curve is going to what? Fall. Because when interest rates are rising, that's the opposite. Okay. So we know aggregate demand is a sum of consumer spending, investment spending, government spending, and net export. So we just talked about it. When the Fed is now raising interest rates, that means net export is going to fall because that's going to appreciate the US dollars, leading to a decrease in net export. Investment in business investment spending is going to fall with higher interest rate. Consumer spending is going to fall. So, but all those are three big components of aggregate demand. That means aggregate demand curve is going to fall. Fall means the shift to the left. So in this case, so if you draw it, what has happened there, we can show that in a diagram how the Fed has closed that inflationary gap. So we are saying if this is your initial, we're having price level here and real GDP on this axis. Let's say this is my aggregate demand 1, and then let's say this is your short run aggregate supply, and then the aggregate, this long run. Remember, the long run aggregate supply curve determines potential output. That's your YP. But the intersection between short run aggregate supply curve and demand, that determines short run equilibrium because it's happening at a point which is not on the long run. So that is your Y1 actual output. So you see, actual output Y1 exceed full potential output. This is your P1. So what we're saying that in this case, how can we bring the economy back to full employment? The Fed is going to increase interest rate by selling bonds. So the aggregate demand curve is going to shift, and it's going to continue shifting until when we close that inflationary gap. See that? So you're going to, I didn't draw this, okay, but you know, it shifts to the left. See, at this point, the black line intersect the other two lines. All the three curves intersect. So in the long run, price is going to fall even further. But the economy is back to full employment. That's how the Fed closes that recessionary gap. They're going to sell bonds, which leads to higher interest rates and lower money supply. Okay. So we talked about all this. This is how the Fed closes the recessionary gap by decreasing interest rate. The aggregate demand curve shifts to the right. This is how the Fed closes the what? The inflationary gap by using contractionary monetary policy. They're going to increase interest rate, which they do that by selling bonds. They can use other tools of monetary policy too, because we talked about other tools of monetary policy like discount rate. If the Fed wants to increase interest rate by using its discount policy, the Fed is going to make it harder for banks to borrow from the Fed by increasing the discount rate. Okay, that could reduce the demand for goods, and because banks are not getting enough loan from the Fed because of higher discount rate, then the banks may not be able to extend loans to we the non-bank public at lower interest. So money supply is going to fall, and then interest rate is going to go up, and then you can see that what? Aggregate demand curve is going to fall. So I just want to discuss something here which happened during the financial crisis of 2007, 2006, 7, 2008, 2009. So we know, you've seen that the policy of the Fed is that the Fed always uses its interest rate policy to keep the economy strong. Meaning that if the economy goes to a recession, how does the Fed grow the economy out of a recession? The Fed must lower interest rate. But what if interest rates are very low already? Let's say they are close to zero. What we call the problem, the zero lower bound problem on interest rate. That is exactly the problem that the Federal Reserve was faced with during the financial crisis of 2007. That the economy went to a terrible recession, but the interest rates in America were already close to zero. Now the question is, how could the Fed lower this interest rate when they were already near zero? Would you make interest rate negative? Of course, because this is a mistake that happened in Japan in the 90s. Interest rates were very low in Japan, and the Japanese economy went into a recession, and then the central bank, the Bank of Japan, lowered interest rate in Japan, and interest rates in Japan became negative. So the question I asked you, what does that mean if we have a negative interest rate in the economy? So that's the idea that if you live in Tokyo at that time, in the 90s, you'd go to a bank and borrow 10,000 yen Because if interest rates are negative, it means you're going to be paying back less than what the bank has what the bank gave you. You think any cent bank out there is going to give you the loan? This notion that you're going to borrow $10,000 from a Japanese bank in the 90s and you're going to pay back $9,000. No. So the Japanese banks refused to lend because they could not lend money at negative interest rate. And the Japanese economy fell. Why? Because consumers in Japan could not get business loans and consumer loans. The economy went to a terrible recession. So when you hear economists that are talking about the Japanese lost decade of the 90s, they are basically referring to that's what we call the liquidity trap. The liquidity trap is a notion that interest rates can become negative. If they are negative, that first of all, people don't want to save money because you cannot put money in a bank, $100,000, expecting the bank to pay you $110,000. When interest rates are negative, that means your savings is going to be less than what you put in. At the end of the day, your total saving value is going to be lower than what you put in. Okay. So we didn't want to, the US did not want to repeat the same mistake because we learned from the history. Okay. From a Japanese case. So once once interest rates were really so low, the federal funds rate that the Fed targets was close to zero. See that, yields is what they call a liquidity trap. The Federal Reserve could not decrease interest rate because the decreasing interest rate would mean interest rate would become negative. So that means conventional monetary policy, things that the Fed had always implemented to restore economic, full employment would not work. The conventional tools like buying bonds, lowering the discount rate, lowering the reserve requirement ratio during bad times would not work because that would lower interest rate and make it negative. So then that was a very interesting, challenging time for the Federal Reserve. So since conventional tools of monetary policy became virtually ineffective in 2007, Ben Bernanke, who was the chair of the Federal Reserve at that time, came up with out-of-the-box policies, things that were never tried before. We call them the unconventional tools of monetary policy. Unconventional in the sense that they were never tried before. And one of those unconventional tools of monetary policy was what we call quantitative easing. So quantitative easing is this idea that because what caused the financial crisis in 2007 was that that crisis started from the U.S. housing market. Wall Street banks had come up with this new concept of securitization, where they would give mortgage loans, bundle those mortgages, and create new financial products out of it, and sell shares to willing investors. We call those bond-like instruments or debt-like instruments that were created out of the mortgages. We call them mortgage-backed securities. So what happened was that the banks that gave out so many loans, even to risky Americans, because they needed the size of these mortgage-backed securities to go up. That would depend on the number of loans you give out. So banks became reckless. They started giving out so many tons of mortgage loans. And not surprisingly, Americans defaulted. And once they defaulted, that means the value of these mortgage-backed securities, and many banks that invested in it, basically fell to almost to zero. The value became toxic. So the Federal Reserve started, the quantitative easing, because banks started failing in America because they were stuck with these useless, toxic assets, mortgage-backed securities on their balance sheets. So the Fed had to go to Wall Street banks and basically buy those toxic assets from the mortgage-backed securities from the balance sheet of banks to shore up liquidity in the U.S. banking system once more. So that's what quantitative easing is. In fact, the Federal Reserve spent nearly $4 trillion. The first round of quantitative easing was called QE1, round one. They spent trillions of dollars, and then they did another second round called QE2. They wanted to do the third stage, but then the economy had already recovered. And it worked, by the way. So look at what happens. Okay. Let me show you the balance sheet of the Fed, how it has changed ever since the financial crisis. So that's what I'm talking about, the QE1. So before the crisis, the size of the monetary base was about a little bit under 1 trillion. Because if the Fed is buying assets from banks, these toxic assets, That means the size of reserves in the banking system on a monetary basis is going to go up. That's what tells you that the Fed is buying assets from banks. So you can see how that thing gradually increased. And then combined with the COVID, because during COVID, the Fed also needed to bail out banks by buying their assets. So think about it. It increased from less to $1 trillion up to around 2019. The Fed has spent close nearly what? See, about $4 trillion. And then COVID hit, so now that went to close to like $7.5 trillion from under $1 trillion. Okay, the other question that I'm going to ask you, can the Fed eliminate recessions entirely? So in our demonstration of monetary policy, the Fed knew how far to shift the aggregate demand and was able to shift aggregate demand exactly this far. In practice, monetary policy is much harder to get right than the graphs make it appear. You know what I mean? In actual practice. And by the way, so completely offsetting recession is not realistic. The best the Fed can opt for is to make recession mild and shorter. Another complicating factor is that current economic variables are rarely known. We usually can only know them for the past with a lag. Okay. The Federal Bureau that is in charge announcing to us that the recession has begun or the recession has ended is the NBER. The NBER is a federal bureau that stands for National Bureau of Economic Research. It's basically a group of elite economists in the country that serve in the NBER, National Bureau of Economic Research. They are all, and remember, the definition of a recession is defined as 2 consecutive quarters of real GDP decline. So if real GDP declines for 1 month or 2-3 months, that's not a definition of recession. It has to decline for six consecutive months. For 6 months, that's 2 quarters of a year. Okay? So that means the National Bureau of Economic Research always announces to Americans, with American economy, about a recession. They give us the news with a lag because they have to wait and observe whether real GDP has actually fallen for 6 months. Like I remember in the recession of 2007, which came up from a housing crisis, that recession started in December of 2007. But the National Bureau of Economic Research did not announce a recession until June of 2008. So they're going to say, well, the recession has begun. That's what they were telling us in June 2008. The recession has begun, but it began in December 2007. Okay? So because, the economy sometimes self-corrects itself, if the government is announcing us a recession with a lag, it started like 6 months ago. That means by the time monetary policy kicks in, or maybe Congress are going to also scramble to bail out the economy using its tax policy and government spending policy. We saw that in Chapter 13, aggregate demand, how the Congress can shift aggregate demand curve to close the recessionary gap. By the time policies start kicking in, sometimes the economy would have self-corrected itself for the most part. So monetary or fiscal policy could end up being destabilizing. Yeah. That's why sometimes we don't get the recession. Federal Reserve can overstep its mandate. So suppose a recession begins in August 2024. The Fed finds out about the recession with a lag, let's say 6 months, in June 2025. You see what I'm talking about? The Fed starts expansionary monetary policy, but the recession has already ended. See, that's what I'm talking about. Because the Fed found it late. So by the time the Fed policy causes an increase in aggregate demand, see, because they lowered interest rates so much. That could increase inflation. Okay? What else do I want to talk about here, which you need for the exam? These are basically moving targets on them. Okay. This might be the last part, okay? So now we can summarize what we talked about, how the Federal Reserve acts in the economy using its interest rate policy or monetary policy. So the the agents of the Federal Reserve that is in charge changing the interest rate by either through bond purchase or bond sale is a Federal Open Market Committee. It consists of 12 members, which include the 7 board of governors of the Federal Reserve System who sit in Washington, D.C., the president of the New York Fed, and then the 4 presidents of other Federal Reserve districts. Remember that there are 12 district branches of the Federal Reserve all spread across the country. Now, the first district branch is the Boston Fed, followed by New York Fed, the Philadelphia Fed, the Federal Reserve Bank of Chicago, the Federal Reserve Bank of Atlanta, the Federal Reserve Bank of Minneapolis, the Federal Reserve Bank of St. Louis, the Federal Reserve Bank of Kansas City, the Federal Reserve Bank of San Francisco, the Federal Reserve Bank of Dallas. So there are 12 district branches all across the country. So this FOMC consists of 12 members, and they meet almost every 1 month and a half, because they meet about 8 times in a year to decide whether or not to increase or decrease interest rate through bond purchase or bond sale. So it's one of the most powerful body of the Federal Reserve System. They're the ones who determine interest rate. So the chair of the board, the chair of the Federal Reserve, Jeremy Powell, is the one who chairs that committee. Okay, so there's 7 board of governors, president of the New York Fed, that makes the number to 8. Then 4 other presidents of the other district branches that I talked about, the other 11 district branches. Those 4 serve on a rotating basis of 1 year. Okay, so let's say the Fed wants to they need to grow the economy. Let's say there was a recession. So when there's a recession, that means the Fed needs to increase GDP, increase aggregate demand. So the Fed is going to turn it. That means the Fed needs to order an expansionary policy. Expansionary policy means the Fed is going to buy bonds, okay? Or they could lower. You know, when I say expansionary here and using tools of monetary policy, it can either mean this guy here. It can mean buying bonds. You know the tools of monetary policy. Or lowering discount rate. Or lowering the what? The reserve requirement ratio, the reserve requirement. Any of these 3 tools is going to be as part of expansionary policy, because they all lead to an increase in money supply and decrease in interest rate. And once interest rates fall, that's going to lead to an increase in investment. Consumer consumption demand is going to go up, and net export is going to go up as well. And that is going to shift the aggregate demand curve to the right. That's how you increase GDP, you grow the economy, and you close the recessionary gap. I already did that with a graph. And then on the other hand, when there are fears of inflation, the economy is overheated, where we are producing beyond full employment. That's what we call inflationary gap. In inflationary gap, the Fed needs to slow down the economy using contractionary monetary policy. Because we don't, some of you might think that, oh, we need the economy to explode in growth. That's not good either, because if there's too much growth, it's inflationary. Because that means think about if every American were to have a job and there's very high income, everybody has very high income. The problem with that is that that's going to create inflation. And we don't want the inflationary gap either. So the Fed is going to slow down economy by contractionary policy. The other contractionary policy, which is the opposite of what I say here. Instead of buying bonds here they're going to what? They sell bond. That's contractionary. We talked about that. Instead of lowering the discount rate here, they raise the discount rate. This interest rate that banks must pay when they borrow money from a Fed. And then they're also going to raise the reserve requirement. The exact opposite of expansionary is contractionary policy, because that's going to lead to a decrease in money supply and higher interest rates. And then investment, consumption, and net exports are all going to fall. The aggregate demand curve is going to shift to the left to close that recessionary gap. GDP is going to fall. So in each of these steps, the changes are relative to what would have happened without a monetary policy. So expansionary monetary policy sometimes is called loose or easy monetary policy. And contractionary monetary policy sometimes called tight monetary policy. So when sometimes the economy is saying that the Fed is pursuing tight monetary policy, it means the Fed is increasing interest rates by decreasing the money supply. And they do that through bond sale, through an open market sale of treasury securities. Or they could do that through higher discount rates. They make sure that when they loan money to banks, banks pay a very high interest rate on the loans that the Fed give them. Or they could raise the what? The reserve requirements for banks. Then the policy is going to be what they call tight policy. I'm not going to test you a lot on this because remember we talk about the dynamic aggregate demand. But if you can study that, that's fine for during your free time. But I'm not going to bring you this a lot on the test because it's a little bit like confusing. You need a little bit some element, but it's actually very easy because with dynamic basically means the long run aggregate supply curve. This technology shock that is pushing the long run aggregate supply curve every period. The model that we just presented, when you look at the whatever here, this is what we call a static model. A static model is we're holding the long run aggregate supply curve constant. See, you notice that yellow looking line never shifts. It always stays constant. That's what they call a static what? A static model framework. The one where we allow also the possibility for the long run to shift, that's a dynamic model, which is here. See? Yellow line is shifting, short run shifting, and aggregate demand curve shifting. Okay, so it becomes complex. Okay, so in normal times, the Fed targets the federal funds rate. One alternative is to target the money supply instead. Should it use the money supply monetary policy instead? Not necessarily. So Milton Friedman says yes, though, because they think that money growth rule, increasing the money supply about long-run growth of real GDP would be consistent. Okay. Monetarism was popular in the 1970s. But since the 1980s, the link between money supply and real GDP seems to have broken down. That's why the Fed switched to targeting the what? The interest rate. Okay, so the last thing I want to talk about here is what we call the Taylor rule. So the Taylor rule was developed by a Stanford University economic professor called John Taylor. Okay. Because remember, the Federal Reserve, the Open Market Committee, they meet about 8 times in a year. But in between meetings, we don't know what the Fed is doing behind closed doors. Whether the Fed is going to raise interest rate, is going to decrease interest rate. So Taylor came up with a formula, a mathematical formula that we can use, you and me, and even Wall Street, the market can use to predict what the Fed might do to interest rate. Because the Fed always surprises the market. You hear, oh, the Fed is meeting maybe in the next month to decide on interest rate, but we don't know how they're going to, the direction of interest rate, whether they're going to keep interest rate constant, or whether they're going to increase interest rate or they're going to decrease interest rate. So Taylor say, okay, if we can tell precisely what the Fed might do, I'm going to come up with a mathematical theory, which I think can guide you to predict what the Fed might do to interest rate. Okay, because it's the one who developed it, it became the Taylor rule. So the Taylor rule is based on two main things. Remember when Congress wrote the Federal Reserve Act that created the Federal Reserve, Congress was concerned about two things. Congress was concerned about inflation. That's why the Fed needs to maintain what we call price stability as one of the main goals of monetary policy. And then Congress was also concerned about what we call the unemployment. That's why the Federal Reserve needs to maintain full employment. So here's the deal. What do we mean by this? First, I'm going to start with full employment. Full employment means that the actual output that the economy is producing must be at its close or at least equal to its full potential. Deviation from this, let's say your actual output, because the economy may end up producing less than what normal output. This is what we call a recession. And that's going to trigger high unemployment. So the Fed needs to act to bring output to its full employment. Or output could rise above full employment. That's what we call inflationary gap. That's inflationary. So the Fed needs to bring back output to its what? To full employment. So that's what we're going to be calling the what. So based on that, we have what we call the output gap. So the Federal Reserve needs to look at the output gap. So the output gap is the gap or difference between actual GDP that the economy produces, actual GDP, and potential GDP. So if I say Y minus YP, that is what we are calling the output gap. And if this output gap is negative, okay, let's say, so there are three possible scenarios here. If the output gap, let's say Y minus YP was 0, that's a definition of full employment. We say the economy is producing at its full employment or at its potential level. But if there's any deviation, let's say Y minus YP were less than 0, then that's a recession. If Y minus YP is greater than 0, that's a definition of inflationary gap. So the last two cases, we don't like that. The Fed must act in any of those two scenarios. For the first one, this last two here. If actual output falls below its full employment value, meaning a recession, the Fed should lower interest rate by buying bonds. We already talked about it. But if output is above full employment, that means inflationary gap, then the Fed might want to slow down the economy through higher interest rates. In that case, the Fed will sell bonds, raise the discount rate, raise the reserve requirement for banks. So that's one gap. Then the second gap is what we're going to be calling the inflation gap. The inflation gap. So we're going to define pi as actual inflation that is in the economy. And then we're going to assume that the Federal Reserve targets inflation. They set a target. They're going to say the Fed might want inflation, let's say it's pi t. This is going to be what they call target inflation by the Fed. Economists always believe that the Fed sets a target on inflation at 2%. Remember, the goal of the central bank is never to make inflation 0. We need some price movement change in the economy. Prices have to increase, but not at a modest. That increase should not turn into a rout. And I want to repeat that the goal of the central bank is not to make inflation 0 entirely. So inflation must be low and stable. That's what it is. And that low and stable for the United States, the target is always at 2%. So the inflation gap is the difference between actual inflation and target inflation. So if this difference equals to 0, we believe that the Fed will not change interest rate because inflation is already at its target. But if actual inflation rises above the Federal Reserve target, meaning that the inflation gap is greater than 0, then the Fed is going to do what to interest rate? The Fed is going to raises interest rate. And if inflation, actual inflation falls below its target, meaning that the gap, inflation gap is less than 0, then the Fed may what? The Fed may lower interest rate to bring inflation back to its target. Okay? So according to Congress, when they wrote the Federal Reserve Act, because of this dual mandate, the Federal Reserve must maintain its two broad goals of price stability, meaning that they should be able to strive to keep actual inflation close to its target as much as they can, about the 2% range. And Congress also wants the Fed must strive as much as possible to keep output at full employment. So when the output gap must be 0, and inflation, that's the target. So then now, because of those two in whatever, the Taylor sets a formula. So if I'm going to write you a question, I'm going to do an example here shortly. So the assumption here is that they are going to be given variables. So there's going to be what we call equilibrium federal funds rate. This is going to be given to you because the economists, with their estimates by economists, given to you. Okay. And then we're going to give you information on what? Actual inflation. And target inflation. Okay. So the formula, the Taylor rule formula is going to be written like this. The formula that Taylor thinks you and me or anybody else out there, the Wall Street or whatever, if you invest money, because interest rate affect our investment. You want to, if you, by the way, let me tell you again, if you can predict movements in interest rate in the economy with precision, you're going to be rich, because then you know when to invest and when to get out of the market and when not to get in the market. Because interest rate determine our stock investments. It determines a lot of other investment portfolio out there. So you can predict future interest rate with certainty, then you are most likely going to do very well on your investment portfolio. That's why this formula is also very important for you from not only from the student learning point of view, but from an investment point of view. So here's the Taylor rule formula. So Taylor believed that, okay, if the Federal Reserve is meeting next month and we don't know because the Fed is going to set a target on what? On the federal funds rate. So we're going to say the federal funds rate target that the Fed is going to set next month, according to Taylor, you're going to take what? Actual inflation. Then you're going to add to it equilibrium federal funds rate target, federal funds rate. And then you're going to add to it 1/2 times what we're going to multiply that by what we call the inflation gap that I talked about earlier. Then you add to it 1/2 times the output gap. That's the Taylor rule formula. Okay. So when I say actual inflation, that's the same thing as current inflation. Current inflation is not. So I can write this in a reduced form. So instead of writing federal funds rate, my notation for the federal funds rate target, I can just write it as IFFT. That stands for the federal funds rate target. And then my actual inflation here, I'm going to write this as pi. That's what we define actual inflation or current inflation. Then I'm going to write equilibrium federal funds rate. I'm going to write this. This is only going to be given to you because economists estimate this. So you write this as IFFR. That's equilibrium equilibrium real. This should be real. Yeah, it should be equilibrium real federal funds rate. The word real has to be there. Plus 1/2. My inflation target is written as you take actual inflation or current inflation minus target inflation that I explained where the Fed wants it to be. Then you're going to add to it 1/2 times the output gap, which is given as actual output minus potential output. So you get, so this stands for that. In short, this stands for that, and then this guy stands for that. Then this is basically inflation gap, and then this is your output gap. Now you realize that the Fed, because of the dual mandate, according to Taylor, the Fed is going to assign equal weight on inflation gap and on the output gap, because the Fed must care a lot about those two things. Goal of the Fed is to maintain full employment, making sure that this gap is as close as possible to zero, and also making sure that inflation is at its target of about 2%. So meaning that this gap should be close to zero. But they have equal weights of 1/2, 1/2. Okay, so let's do an example. Because an example clears things up. So you know if that's the Taylor rule formula. So I'm going to say example on the Taylor rule. I'm going to say suppose actual inflation is, or the word actual means current inflation, because actual means that we know it is, let's say, 2%. And target inflation is all about 2%. Target inflation is always 2%. That's a target we believe is also 2%. If the equilibrium federal funds rate is 2% and GDP is at full employment, okay, what should be the target on the federal funds rate set by the Fed according to the Taylor rule? So you already know the formula. The formula says, in short, that the target on the federal funds rate must equal to, you take actual inflation pi plus equilibrium federal funds rate, equilibrium real federal funds rate, then plus 1/2 times the inflation gap, which is pi minus pi t, plus the output gap, y minus yp. Okay? So now the question says that the GDP is at full employment, meaning that actual GDP equals to full employment. So if the GDP is at full employment, that means the output gap is zero. That's what that means. And then we have also been given, we've been given that the actual inflation is 2%, and the target inflation is also 2%. So that means this gap is going to be zero. 2 minus 2 is zero. And then we have been saying, they have told us this is 2%, and this is still 2%. So then according to the Taylor rule, that means the Federal Reserve should set a target on the federal funds rate equals to 4%. It's going to be this 2 plus 2, 4. This is 0, because 2 minus 2 is 0. 1/2 times 0 is 0. This is 0. This part is going to be 0. This part is going to be 0, based on that. So according to John Taylor, when inflation is at its target and GDP is at full employment, the federal funds rate must be set at 4%. Okay, so let's do one or two more examples. Now, suppose something changes here. Let me do. Okay, example 2. We can say, suppose actual inflation rises 1 percentage point, 1 percentage point above its target, of 2%, and GDP is at full employment, if the equilibrium federal funds rate, if the equilibrium real federal funds rate is still 2%, what would be the target on the federal funds rate according to the Taylor rule? So let's do this. Okay, so right, so they said suppose actual inflation rises 1 percentage point above its target of 2%. So that means you summarize it. You mean we know target inflation here is 2%. So if actual inflation rises 1 percentage point above target, that means actual inflation is 3%. So what that means? That's 1 percentage point above its target. If it was 2 percentage point above target, it would be 4%. And GDP is at full employment. That means the output gap is already 0. It means actual out. When I say GDP is at full employment, it means actual output equals to potential output. So the Y minus YP would be 0. And then equilibrium federal funds rate, real federal funds rate is given as what? 2%. Then we write the formula for the Taylor rule that's saying the target on the federal funds rate, according to the Taylor rule, would be you take the actual or current inflation plus real equilibrium federal funds rate plus 1/2 times the inflation gap plus 1/2 times the output gap. So that means IFFT would be, this is 3%, remember? Because they're saying actual inflation is, and then this is 2%, then plus this is going to be 1/2. So this is going to be 1% in bracket. Because 3% minus 2% is 1%. Because actual inflation here is 3, this is 2. Then plus 1/2, the output gap is 0 because GDP is at full employment. So this part is 0. Okay, this is 5% here. 3 plus 2, the 1/2 times 1, that's 1/2. So that according to Taylor, if inflation rises just by what? 1 percentage point above target, we should raise the federal funds rate from 4%. Remember the previous case when inflation was at its target and GDP was at its full employment, the Fed should set the federal funds rate at 4%. But according to Taylor, if inflation just rises 1 percentage point above its target range, then the Fed should raise the federal funds rate by 1.5%, or that's like 150 basis points. Okay, from 4% to 5.5%. Okay, so then I want to just do one more example on this because this is interesting. What about if output was a problem? Let's say the economy was the one falling in a recession and inflation wasn't a problem. Sometimes you may get both problems, what we call stagflation. Stagflation, when you have both rising unemployment, that's falling output and what? And rising inflation. Okay, but let's assume that example 3 here. Still on the Taylor rule. Suppose real GDP falls 1 percentage point below its full potential value. Full potential is the same thing as full employment. Sometimes I might write full employment, it means the same thing, or long run value. Potential, full potential value. If current inflation, current is the same as actual inflation, If current inflation is at its target, value of 2%, and equilibrium federal fund, equilibrium real federal funds rate is still 2%, comma, use the Taylor rule to predict the Federal Reserve targets, the Fed's target on the federal funds rate. Okay, so you know that. So we've been told that what? See, so if output falls 1 percentage point below, that means the output gap, which is this gap here, y minus this gap here, is negative 1%. That's what that means. It's falling 1 percentage point below. If I put that, suppose output, our real GDP rises 1 percentage point above its potential value, full potential value, then that will be positive 1% because it's above. But if it's below, that means negative. Okay, but then we have been told that now inflation is back to its what? To its target rate. So that means, no, inflation is, yes, it's back to its target rate. That means pi minus pi to the t is 0 because about 2%. 2 minus 2 is 0. And equilibrium federal funds rate, real federal funds rate is still 2%. Okay, so that means we're going to calculate the what? The target on a federal funds rate according to Taylor. Formula is the same. You take actual inflation plus equilibrium federal funds rate target, real interest rate plus 1/2 inflation gap, which is pi minus pi t plus 1/2 times the output gap, y minus yp. So according to Taylor, when output falls 1 percentage point below target, you know that when actual output is falling below its full employment, that's like economy going to a recession. We need the Fed needs to close the recessional gap. So you need to know that does the Fed close the recessional gap? We already talked about that. You connect that to what we talked about. Do you need to what? Increase aggregate demand through expansionary monetary policy. The Fed needs to either buy bonds, lower the discount rate, or lower the reserve requirement. So that expansionary monetary policy is going to lead to higher money supply and low interest rate. That's right. So that means the federal funds rate here must decrease. The Fed is to decrease the interest rate. So here's going to be, so pi here is going to be 2% because that's we have been told that. And then this is 2%. This is 1/2 because we've been told inflation is back to its target. That means 0. Then this is 1/2 times negative 1%. This output is 1% below target. The output gap is negative. So 2 plus 2, that's 4%. This is 0. This is negative 1/2. 1/2 times negative 1. So that means, according to Taylor, 4% plus negative 1/2, that's going to be 3.5%. So according to Taylor, if output falls 1 percentage point below its target, the Federal Reserve needs to lower the interest rate by 50 basis points from 4% to 3.5. It must lower the interest rate by 0.5, or what they call 50 basis points. So that's a Taylor rule. You got a couple of examples on the what? So here's a formula written in full. Then there are other monetary policy tools that I'm not going to go through it. If you want to study this, I'm not going to test you in them, like inflation targeting. You can study that during, it's a new framework of monetary policy. The Federal Reserve has never implemented it. It started from New Zealand, of all places, then it spread to an increasing number of central banks in Europe, and Canada is also in emerging markets like Brazil, Israel, all those countries target inflation. We talked about that. You can reserve that for your upper division econ classes. Okay. And then also these parts, these are kind of like if you want to read about what happened during 2020 financial crisis, the case study, you can say that because, you can just, you basically just case studies. You can study doing your own on what happened during COVID based on what we already talked about. Okay, this is just your readings, but I'm not going to test you on any of these last piece. But for your own, whatever, you can read about it and how the government responded to both the COVID-19 and the recession of 2008. Okay, so that's it about this chapter. And thank you for listening. I will I'll process this video and upload it at Canvas so that you get a chance to watch it, because it's going to appear on your exam, which is coming up on Friday. Thank you very much. Bye-bye.